Hello everyone, it's Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool. And this is another in my continuing series on YouTube subscriber request series. I was recently asked to take a look at DXC technology, and it was kind of an interesting request because this company was formed with the merger of Computer Sciences Corporation, CSC, and Hewlett-Packard Enterprises in 2017. And I think what you're looking at here is actually primarily computer sciences historical graph. So what I've got to do, first of all, is shorten this graph so that we're looking at the new company. It was formed in March of 2017. So the actual current company looks like this. This is how it's operated. Now, by the way, note that they do have a March fiscal year. The company has already made several acquisitions, which has been kind of computer sciences modus operandi for a long time. But looking at this stock from fundamental point of view is what I want to do. And I'm going to ignore the long history here and just focus on this company as a going enterprise. First of all, I'm going to start with operating earnings and look at what the company's done. Now, the growth rate has averaged about 26%, but it is expected to slow down. And it is having, the analysts are forecasting negative growth through March of 2020 of about 14%. Now, the dividend record of this company has been good. They've increased it twice as this going concern. The longer-term growth rate of the historical company also has a good dividend record. I'll go ahead and show you that just so at least you have that perspective. Let me get it out here to where you see the whole record. So the company, when it was Computer Sciences, paid its first dividend in March of 2011, and the dividend has grown by an average of 14%. So this tells me management does have kind of a commitment to their dividend, if you will. Now, the new enterprise, the dividend has been growing nicely. Here are the valuation metrics. The company is currently trading at a PE of 3.6. Now, its historical normal PE, since it's been a company, has been closer to 12. I think the stock is worth a 15 PE. In fact, looking at Morningstar gives it an $88 fair value, which would be in line with this normal PE of about 12.5 for a fiscal year end. FastGraphs would show 90. Morningstar is saying 88. I think that's roughly the same number. The stock is obviously then extremely undervalued. It's currently available at a 3% yield. It's a $16 billion company with total enterprise value. They do have about 7.8 or 9 billion in debt, but it's only 40% of their debt to their capital, so it's not that overly leveraged. The company's market value is 7.24 billion. It's BBB rated. And it's really kind of an interesting tech stock. I think the story here is undervaluation. So let's look at some other metrics. Let's go and let's look at operating cash flow and then free cash flow, because what I really want to talk about here is dividend coverage. Forget price. Obviously, operating cash flow dropped, and you could see that triggered a pretty precipitous drop in stock price. But operating cash flow is expected to increase quite nicely over the next couple of years, by 28% this fiscal year, again, which ends in March of 2020, and then follow that by a 41% before they expect it to maybe start falling again. So forecasting operating cash flow, the company looks extremely undervalued. Now, if I apply a normal multiple of about 9 times cash flow, the rates of return here would be extraordinary. So from a standpoint of operating cash flow, two things. The stock looks very undervalued, number one. Number two, the dividend is extremely well covered by operating cash flow. So let's move on to free cash flow, which I always consider to kind of be the acid test when looking at a stock. And so when I'm looking at this company from a standpoint of free cash flow coverage, and again, I want to look at it from the perspective of the current configuration of the company, I see the similar story that I saw with operating cash flow, and that is, free cash flow over $4 a share is covering a 48-cent dividend and expected to be just under $7 a share, or was $7 a share last year, covering a 60-cent dividend. And even though free cash flow is expected, or did drop in fiscal year 19, which ended in March, it still was $5 of free cash flow covering a 74-cent dividend. And then this year's expectations, finally, I've been wanting to get to that, obviously, this whole discussion on free cash flow, is $5.06 of free cash flow covering an estimated 83-cent dividend. So from a standpoint of cash flows, the company is extremely well covered. Now let's move on as another valuation reference on to EBITDA. EBITDA growth has held up a lot better than the other metrics I've looked at here. I really don't understand how this company could be trading at less than 2 times EBITDA, but unless there's something here that I'm missing, and that's really part of this presentation, this is a research candidate. I was asked to analyze it, so I'm simply looking at it by the numbers here. The valuation is ridiculous. I mean, the amount of money that you could make if this stock returned to some normal valuations is just staggering, and I'm not sure what's keeping, everyone down here. Perhaps it's the uncertainty. The company does make a lot of acquisitions. They do have a little bit of debt. It is a technology company. It's kind of transforming itself. The merger of Computer Sciences and Hewlett-Packard Enterprise was the start, but they've also made numerous acquisitions from some of the research that I'll call it preliminary research that I have conducted on the stock. All in all, this is a very, very intriguing company. I did look at a couple of other metrics that I felt were important. I went into fund graphs here, and what I did was I wanted to look at what's happening with their margins. So I'm looking at gross and net profit margins here, and I'm going to again shorten this to a recent time frame. And they did have some negative margin in 2017. Now this was the merger year, remember, but their margins have been improving, and over the last several quarters their margins have actually gotten a lot better in fiscal 2018 than they were in 2017. So I kind of like that. It looks like the company's improving quite a bit. Then the next thing I wanted to look at was just simply gross revenues. The company's revenues were falling. It's probably maybe what stimulated the merger. But again, if I look at just these last years since the company has merged, and that's really 2017 and 18, revenues are growing again. So, this is a very positive sign to me. The company is extremely undervalued no matter what valuation measurement you look at, given that all these forecasts and all these numbers are correct. So it's got a 3% yield, an extremely low valuation. It's 2 high quality, previously well-respected tech stocks that have merged together here, and their growth potential is extraordinary. So if you're looking for something a little out of the ordinary, I would take some time and spend some time looking at this company. You might want to start out by going into the company's website here and looking at what they're doing and some of their initiatives that they're planning. You can also go through here and look at slide presentations that the company has put on recently. There's a lot of things you could find in the company's website. So, here's a great idea to look at, an unbelievably low valuation. Morningstar gives it an $88 fair value. The stock's available at $27. I really don't understand what's going here. I'm going to be taking a closer look at it myself. The stock is up 2% today, which is kind of nice. So the market's maybe starting to get some traction. This could be a great time to look at a great, at least intermediate term opportunity, and even perhaps long-term opportunity. Anyway, this has been Chuck Carnival. Thanks for watching. If you liked this video and felt it was of value, don't forget to subscribe to our YouTube channel by hitting the button below. Thanks again.